Hello everyone, my name is Dheeraj and today I'll be presenting my analysis of the UK clothing retail industry using business analytics techniques. So, the UK clothing market continues to change quickly as the economy and customer behavior shifts. In 2024, people spent around £67 billion on clothing, but market growth slowed by minus 2.3%. This shows that although customers are still buying, they're more careful and price focused. So, online shopping continues to grow, and brands like Next and ASOS have strong omnichannel strategies. And Primark focus heavily on low prices and volume. And sustainability and personalization are also becoming more important in shopping business. And the main aim of this analysis is to show how data can help us understand financial performance and support better decision making. I use data from 2015 to 2024 to identify changes in sales, profitability, and financial structure. The findings help us to understand how companies can remain competitive in this challenging industry. Now let's look at the overall market picture shown in the dashboard. So they, this dashboard gives us a clear snapshot of current market conditions, and the industry is slowly recovering with around 5.2% growth expected between 2021 to 2026. And women's clothing remains the largest spending category, followed by men's and children's. And London is the strongest region market with higher purchasing power. And the major companies like Primark, Next, and H&M still lead industry trends. This high-level view help us identify which companies are performing and well and where challenges exist. And now let's talk about how data was collected and which companies rank where. And here I use secondary data from reliable sources, including Fame, Statista, and Ibis So, I selected 8 companies that represent different segments of UK market, such as value, fashion, premium, and lifestyle retailers. These include Primark, Regatta, Moss& and Bros, Ann Summers, and C&J, Clark International Limited. The data includes turnover, profit before tax, assets, shareholder funds, and profit margins. These financial indicators allow us to fairly compare company strength and weakness. And next, I'll show the financial performance using visual charts. So the turnover varies a lot between companies, and the Clark shows the highest turnover at about £682 million, while smaller firms have much lower figures. And profitability shows about Regatta and most pros perform strongly, but Anselmers and Clarks report losses. This suggests that having high sales does not guarantee high profit. Uh, Cost control is essential. And the asset chart shows that companies with larger physical investment like Clarks have stronger business backing. However, they still struggle with profitability. Now let's look at the shareholder strength and profit margins. Next slide. Yeah. So the shareholder funds represent long-term financial stability, and Clarks and Rigor shows the strongest equity positions. Primark and Frasers Group work with small equity, which can be riskier but flexible. And profit margins are high at Primark and Frasers Group, both above 7%, and Summers and Clark shows negative margins, meaning they are currently unprofitable. And this confirms that large sales alone are not good enough. So good profitability needs strong and cost and pricing strategies. To better understand these differences, now let's look at the descriptive analysis. Yeah. So the average turnover sits around £158 million, but with a high standard deviation, showing huge differences between large and small retailers. Profit margins are generally low at around 2%, proving that retail is highly competitive with constant pressure on the cost. So this tells us that the market is mixed. Some companies perform strongly while others struggle to survive. So next we'll explore the relationship between the financial measures. So yeah. So it's a correlation analysis. Um, yeah, our correlation results show that companies with strong tangible assets also have strong turnover and shareholder funds. This means investing in stores, stocks, and logistics supports revenue growth. However, a profit margin doesn't strongly connect to turnover. So even big companies can have low efficiency. The main message is that retail sectors need both investment, strength, and good cost control. Growth without efficiency is risky. So now let's look at the predictive model. All right. So the regression analysis. The regression model has a very R square, high R square, so above 99%, meaning our selected factor explain most changes in turnover. But due to small sample size, individual variables are not statistically strong on their own. This shows that performance comes from a combination of financial drivers, not just one factor. And predictive analytics can help companies plan better and choose where to invest for future success. Based on this insight, I propose some recommendations. So, from the analysis, I recommend four actions for retailers. The first one is improve asset utilization. So, smart logistics and digital stock tracking. The second one is strong cost control for reduce waste, automate process. Third one is invest more into digital and AI tools for a better customer targeting and faster services. And the fourth one is maintain a healthy financial structure to protect equity and stability. These steps help retailers stay profitable and competitive. Now conclude with my findings. So the UK clothing retail industry remains tough and competitive. Companies with strong assets and shareholder backing usually perform better, but low profit margins show that reducing costs and improving efficiency are essential for success. And business analytics help retailers understand what truly drives performance. To stay successful, companies must keep adapting, investing in technology, and focusing on smart financial decisions. And that's pretty much it. Now, these are my references.